Hi, I'm Sumera Abdi, and with me is Gaurav Mehta, Chief Investment Officer, Equity of SBI Alternatives Business. And we're here to speak about the latest position of our AEON Alpha PMS. The market has been heading higher, and from November, in fact, we have seen a secular up move. We are practically at fresh highs, and it is so tempting now to throw caution to the wind. But this is exactly the time that we need to be cautious, Gaurav. Would you agree? That perhaps it's the time to be a little bit more cautious, and is that the reason why we are seeing this bit of underperformance in the fund as well?
I think to answer your first question specifically, we obviously fall back on our asset allocation framework to take a view on, equities versus bonds and so on. Although, even that framework is not supposed to talk about short-term market timing. It's more a structural guide or nudge towards how much equities and how much debt and so on. And there, I think there are two things that need a little bit of caution at this point in time. One, obviously, is the valuations aspect, that valuations have been a bit expensive. And again, we look at valuations relative to bond yields. So equity valuations versus where bond yields today are a bit on the expensive side. The second thing that we also track is the overall market sentiment. And on market sentiment, we are now seeing readings on our model, which suggests that there is a bit of complacency and euphoria that's starting to build in. So that, yes, would mean that one needs to be a little cautious. But the third aspect of this framework, and which is the most sort of positive aspect about the country today, is on earnings. And if you track earnings in India, and we track that through a simple ratio called corporate profits to GDP, and profits to GDP in India were secularly declining between 2008 and 2020. It's only over the last 3 odd years that you've seen a reversion higher in profits to GDP, where profits have started to outpace nominal GDP growth. And usually these cycles on corporate profits lasts a few years. And to the extent that you've just had 2-3 years of upward reversion, I think that gives you hope that you're in early stages of an earnings expansion cycle. And when earnings are strong, markets tend to do well over a long-term time frame. But from a here and now point of view, as I said, given the expensive valuations and given where the market sentiment is looking a little stretched, some of those positives from a here and now point of view look like they are in the price. How does that impact our strategy on the AEON Alpha PMS? It doesn't, not a lot, because our approach there is to be very bottom-up driven. We can take cash calls there up to 35% of the portfolio, but that's something that we do in very extreme and very rare cases where you have a combination of peak earnings, peak valuations, and peak sentiment. That thankfully is not the case today because earnings are still looking up. But there, overall, otherwise, in normal market situations, the strategy is very bottom-up driven, where you look at a core portfolio and a satellite portfolio. Core portfolio is what's supposed to be a long-term structural compounding portfolio. Satellite is where you try and play any macro or thematic ideas, which will do well over a 2-3 year time frame and give non-linearity to the portfolio. Now, that portfolio construct hasn't changed because of the market up move or otherwise. Yes, we have trimmed some allocation to satellite recently, but otherwise, not a whole change there. But yes, on an overall basis, today core is higher than satellite, and to that extent, I don't want to use the word conservative, but to that extent, we are a little less adventurous. And usually this is something that we have seen historically, that whenever markets rise in a linear fashion, given the long-term sort of outlook of our companies, and given that overall portfolio beta is quite low, to that extent over short periods. And the other aspect that I also want to highlight is that we run strategies where we're not even looking at the index. So to that extent, the overlap between our portfolios and index is extremely low. And that means that over short periods, whatever the index is doing, either on the way up or on the way down, has little bearing on the portfolio. And yes, to that extent, I think the up move that you saw in December, the portfolio won't have kept pace to the same extent. But when you think of the year as a whole, we have still ended up with a very strong outperformance versus the index.
Absolutely, Gaurav. But you mentioned also that you've seen some trimming in the satellite portfolio, so there have been some exits there. So can you just take us through, what the exit strategy is?
Right. So overall, again, the exit strategy will depend whether it's part of the core portfolio or the satellite portfolio. In the core portfolio, our approach is to not sell something. I mean, ideally, these are businesses that you want to own forever, because these are in sectors which are more structural in nature. These are very strong managements who have seen past macro cycles and navigated them well, and which is why your ability to say that the high profitability and growth and the earnings compounding will continue irrespective of the macro is pretty high. So there, the exit strategy is that only when there is some major disruption or there is some major change in the way you have assessed the business, unless that happens, you want to continue holding on to these businesses. Satellite is where we are a little more nimble. Here, for example, if there's a change at the sector level, which is something that you're trying to play, or a change at the overall macroeconomy level, or a change at the individual sector level, that's something that you're playing. And initially, your investment time frame is 2 to 4 years. But again, sometimes you may end up holding these companies for a much longer time frame. And in other cases, you may have to exit it before that 2 to 4 year time frame. And usually these exits will happen either because the initial change that you were thinking will happen, which will improve the fortunes of the company and the sector, hasn't materialized to the extent that you initially thought. Or in this case, we are also very sort of selective about valuations. Sometimes you see improvement in valuations, which is much ahead of what you would have initially thought, and which is exactly what you've seen over the last year or so. Many of these satellite companies have done very well. The cyclical tailwinds have been strong, but the stock return has been so strong that at these valuations, we think that even with the cycle panning out exactly the way we thought, perhaps the returns in some of these stocks will be subpar because the trailing returns have been so strong. So in those cases, we've made some amends to the portfolio so that on an overall basis, the portfolio still stays balanced and well poised to deliver on a 2-3 year time frame.
Okay, but would it be fair to say, or rather, I should ask you what your view is, that, because the run-up has been so strong, like what you're foreseeing with the stocks, that, perhaps there might be a correction. What about the overall market? I mean, for the fund itself, the last 1 year has seen happy investors, right? So now they want to just know that is there a market correction coming? And since your portfolio is not a replication of the index, therefore I'm assuming that it might be immune to this coming correction?
I mean, eventually we're running a long only portfolio, so I would not say that we are immune to any sort of market correction. But our endeavor has been through this core satellite approach, especially when you think of the core portion of the portfolio, it's focused on long-term compounding. And these are essentially very highly cash generative companies with high ROEs. So whenever there's a big drawdown in the market, the core piece tends to significantly outperform. And similarly, when there's a big up move in the market, the satellite piece seems to give the upside participation. So we think this balance works well, and which is why if there is a market correction, we are not, again, as I said, this is a long only portfolio. It will fall if the market falls, but we are fairly confident that we'll navigate the downside pretty well. On the exits, it's not that we are so much exiting them because we're not finding alternative opportunities. As I said, we exited these companies because we thought that in those specific cases, the valuations had run ahead of fundamentals. That said, it's not that our cash levels have dramatically increased to express a big market view or anything. We have found alternative opportunities where where valuations were still reasonable, and where even in the satellite piece, we thought that you could still have non-linearity from a 3 year time frame. And to that extent, we've just sort of moved or churned that portfolio in favor of better opportunities. So on an overall basis, it's not that we've raised significant cash or anything, but yes, markets have run up a bit too fast. But even if there is a correction, we think because of the high focus on core, and as I said today, as we speak, core has actually increased in relative terms versus satellite. So that should protect the portfolio in case of a big downside.
All right, and that's the confidence that you have. Thank you very much, Gaurav, for speaking about the AEON Alpha PMS.